the July 2022 issue of the Zavitz and Sykora Financial Strategies newsletter. My name is Greg Sykora. I'm your financial advisor. Thank you for tuning in and listening to our update. Our goal with these updates is to talk to you about the performance you've experienced in your accounts, to talk about interesting things we've read and come across over the past month related to financial markets, and educate you on financial planning and financial strategies that may benefit you. From time to time, we also hope to bring to you professional guest speakers from various topics that we think are important to you. So I'm going to turn over to Mark, who you're most familiar with, obviously my partner. Mark's going to introduce me and explain our partnership in a little bit more detail for those of you who have yet to meet me. Go ahead, Mark.
Yeah. Good afternoon, everyone. So as Greg mentioned, we're going to have a brief discussion today. About half of it is going to be me introducing Greg, and the other half we're hopefully going to talk about some new things that we're introducing for all the clients that are going to help everyone get some better returns. And hopefully there's some interesting topics to boot. So guys, as most of you know, I'm 61 next week.
Next week.
This is my next week, Greg. Yeah, I got a birthday July 15th. So this will be my 39th year in business. I hope to be around for another 5 or 6 or 7 or 8 years, but I've been actively looking for a very competent partner and a successor for the last 5 years. I've interviewed somewhere between 30 and 40 advisors. And fortunately, last summer, Greg Sykora, my new partner, as of November 2021, fortunately, Greg called me. Greg was, well, let's just back up. Greg grew up in Fond Hill, went to high school in Welland, went to Brock University, got his business degree, and then he moved to Toronto, downtown Toronto, as most young financial people do, to try and get involved with some of the bigger financial institutions. Greg started, actually, as the screen shows, worked for 4 different groups. He started with a very large advisor, Garth Turner, who worked through Raymond James when he first got out of university. And Greg was involved in working with ETFs for his 4 years at Turner Wealth Management. He had a very short stint with a hedge fund company, and then a couple of years working as a manager of business development at Fidelity. And then the last 5 years, up until the fall of last year, he was a district vice president for Mackenzie. That's where I got to meet Greg. Greg was my wholesaler. Mackenzie wholesalers have 200 or 300 or 400 advisors like me that they look after.
It's absolutely brutal. It's absolutely brutal.
You know, their responsibility is to contact us, be proactive, make sure that we understand the products, and pass on tax and legal information, and you know, just sit in on, listen to all the various investment management groups, and then pass on the information. So it's very helpful. And over the years, over the last 5 years, Greg and I either got together or had phone conversations probably 20 or 30 times. Greg's life changed a couple years ago, and he decided to get married and buy a home in Burlington and move out of downtown Toronto. They had a baby boy, Preston, who's about 9 months old now.
Yep.
And so, yeah, congratulations, Greg.
Thank you.
So life changes. And so this summer, Greg contacted me and said, Mark, you know, we've been talking about your succession plan and how I can refer advisors to you, and you know, where are you at with your succession? And I said, not very far, and I haven't found anyone yet. And Greg said, well, I'm now interested. So we talked for a couple or 3 or 4 months, and we hammered out a deal, and Greg bought my company in November. So here we are. So we've been working together now for about 8 months.
Yeah.
Yeah. So we're working together. So what we're trying to do, well, I guess we should talk a bit about what I was looking for. I was looking for a young advisor because this is not only a partner that I'm looking for, that I need, but also a succession plan. And Greg's 35 years old. In his first 12 or 13 years, when you work downtown Toronto for the big financial companies, you are expected to learn a lot. And so, if we look at the chart, Greg's industry credentials are quite significant. Over his 12 years after university, Greg got his certified international wealth manager designation. He got his chartered investment manager designation. He got his securities designation, and he got his certified financial planning designation. So that's an awful lot to accomplish in 12 years, and that's also something I was looking for. I was looking for it for myself, and I'm obviously looking for it for all of you. I wanted to get a young advisor that had lots of experience and lots of knowledge. So I don't have time to train anyone, and I don't really need to train Greg. I can help him a bit on the experience side, and I will. But no, he knows his stuff, and we're both going to be in good hands. So
Thanks, Mark. You've said this a few times in some of our meetings already that we may have already had with you, but every time I hear it, my head gets a little bit bigger. So I appreciate it.
yeah, no problem. It's well, Greg, look, I quite frankly, like I said, I looked at about 40 different people, and there were very few, maybe one that had more credentials than you, but they were also 20 years older.
Yeah.
So
Well, thanks.
so that's good. So as I mentioned, Greg started with Garth Turner, who was our finance minister for a little less than a year. He worked for Garth, and Garth was one of the first practices in Canada that really started using electronically traded funds. They're called ETFs. And so Greg started out there. One of the things that's been happening in our industry is the development of ETFs, electronically traded funds. ETFs and mutual funds are similar in a lot of ways. They represent, different asset mixes. So you got a global balanced mutual fund and you have a global balanced ETF. They're very similar in what they accomplish. You can have very conservative pools, and you can have very aggressive pools, and you can have pools or portfolios in the middle. I'm going to let Greg talk for a bit because he's got 12 or 13 years experience with these newer products, and these newer products have some significant advantages,
Yeah.
and Greg and I are going to transform the practice over the next year or two, and we're going to speak with each and every one of you and introduce electronically traded funds into your portfolios to enhance your returns. Go
Yeah.
ahead, Greg.
Thanks, Mark. Yeah. So, first and foremost, you may have read about ETFs. If you go to the Globe and Mail finance investing section or National Post or Toronto Star, and you read some of the columnists there, you'll notice that almost every day there's an article speaking to ETFs. And the reason why ETFs are gaining in popularity is because they basically do what a mutual fund does, and that's they buy a basket of stocks, a basket of bonds, or a basket of stocks and bonds, but they do it at a fraction of the cost. The reason why they do it at a fraction and how they're able to accomplish that is because the management style associated with an ETF, as you can see on this screen, it's passive. And that's significant. What we're coming to learn, and what I'll speak to in a few slides, is the fact that passive and ETFs in general, which are generally passive, passive ETFs outperform typically active mutual funds somewhere between, on average, 90 to 95% of the time. So if we're able to find an investment vehicle as an investment advisor and financial planner for you that has a much higher probability chance of delivering better returns, well, we think it's our obligation to introduce these investment vehicles to your portfolio. I use them in my portfolio. Mark's starting to use them in his portfolio. We didn't have the ability, and Mark didn't have the ability to use ETFs until last year. And as some of you may have noticed, the investment dealership that we are partnered with is no longer Fundex. It's now called Investia. Well, Investia, so we haven't changed, but it's now under the Investia umbrella. Investia just launched a platform that allows advisors like Mark and I to actually buy and use ETFs in your portfolio. So it wasn't available to us. Otherwise, I know it was something that even before I'd begun to work with Mark, Mark was looking into, and he likely would have tried to add to your portfolios at some point, regardless of if or not I was here. It was more of a bonus that I was already skilled in being able to use them. Now, ETFs are not just a fad. They are something that is growing substantially in Canada. The overall size of the investment landscape in Canada is right around $2 trillion. It's just over 2 trillion. ETFs represent around 300 billion. So about, 15, 16% market share of the total investment vehicle in Canada. And it's significant enough that over the next 10, 15, 20 years, the expectation is, with all these cost benefits, that ETFs eventually surpass mutual funds. Now, as I was previously stating in the slide before, the reason for that is generally performance related. Well, in the United States, they've got a whole bunch of think tanks and research that look into these mutual fund managers that cost a lot, that say that they can outperform. How well do they actually do against an ETF? And for sake of looking at this slide, an ETF is also the benchmark, the respective benchmark. Well, if you look at the various categories of investments you can have in the United States, specifically the US market, you can see that almost 90 to 100% of all of the different sectors and areas for ETFs in the United States, almost all of them are dominated by benchmarks, which are passive ETFs. So in our from our perspective, we don't want to go against the grain. I personally think that building a portfolio of managers that are that small light blue sleeve that you see here, that's an old way of building portfolios. It doesn't make sense, and it's extremely challenging for advisors like Mark and I to pick and choose that 4 to 5% of managers that's going to outperform. Is that, would you agree with that, Mark?
Yeah, absolutely, Greg. We only have, it wasn't always this way, as you mentioned. 20 years ago, it was more, 20 or 25 years ago, it was more of maybe a 50-50 mix as far as performance. Actively managed funds were able to add value and pay for their extra fees, the extra cost, and the net performance was similar to ETFs. Which are significantly lower cost, as you mentioned. But today, as this chart shows, this is looking at 20-year compound returns. We virtually have no chance if we use the blue sleeve, which is actively managed funds. We have almost no chance of adding any value if we only use actively managed funds. So, the data, the stats now is it's very clear that lower cost passive ETFs are the way to go. and we have to use them because they're going to provide better performance for everybody.
Yeah, and
And
it's a phenomenon, right? That, you know, when you look at not only the Canadian market, but also specifically the US market, where ETFs have been gaining in popularity, and their market is roughly, you know, we'll call it 20, 30 times the size of ours. You know, you look at the shift from using active equity mutual funds that are more expensive. Well, you know, the amount of assets that's leaving over the past, you know, 10 years, that's $2 trillion that's gone from being invested in active equities, as seen in red here, into a passive or ETF strategy that is essentially the benchmark. And that's because guys like Mark and I are choosing, when we help our clients invest, not to use these active equity managers anymore. You know, the Wayne, you use a good analogy, right? A Wayne Gretzky portfolio manager. Well, those Wayne Gretzky managers 30, 40 years ago, they used to have access to information that the market didn't have access to. You know, if we look back to Warren Buffett had almost exclusive information by nature of the fact that he had access to CEOs, like the CEO of McDonald's, which gave him insights to buying stocks, and then he bought them and he held them for many years. Well, nowadays with the internet and the free flow of information, this is known as an efficient market that acts rational. Well, nowadays, that flow of information means that there's no competitive advantages for anybody anymore. Like it's almost impossible. And that's why we're seeing that struggle in active management, that piece of the pie keeps getting smaller and smaller and smaller, because it's impossible to do. And it's impossible for advisors, again, like Mark and I, to get the results that we're looking for by exclusively using them. So that's why we're making that shift. And if we look at the Canadian market, we already talked about the US market. It's, you know, 23 times the size of ours. This is the most recent stats that I was able to pull on what's going on from a flow standpoint in Canada. Not that I expect anyone to understand what some of this jargon means, but in essence, you know, the mutual fund industry in the month of May lost 6.4 billion in total assets. This is while the markets were actually going down, but the ETF side of the Canadian market went up 2.6 billion in net flows. So that's a difference of around 9 billion moving, and a lot of it came to the ETF side of things, which is why it's positive, despite it being a bear market that we're in today. So,
well, Greg,
yeah,
I don't have the exact data, but I believe in the States and quite possibly even in Canada that the ETFs have attracted have attracted more assets than the mutual funds probably every month for the last 10 years.
yeah, it's I don't know about the last 10, but I know for sure the last 5. The last 5 hasn't even really been close, and that's, you know, the growth of the availability of ETFs. We didn't have very many ETFs 8 or 9 years ago. I think there's, you know, 100 different ETFs in Canada. Well, now we've got close to 1,000 or around 1,000-ish ETFs. And just by nature of that, you know, we're able to use ETFs to get exposure to markets that we couldn't 7, 8, 9 years ago. And that's where a lot of that growth has come, the availability of them, but also giving advisors like Mark and I the ability to add the exposures that we want, not having to rely on active mutual funds to do so. So, but case in point, ETFs aren't everything. There are certain things that ETFs can't do. They can't get exposure to certain areas of the market. And we do still believe in using active management for those areas of the market that ETFs unfortunately can't do. Eventually down the road, when ETFs are able to, from a cost efficiency standpoint, gain exposure to those areas of the market or those strategies that we're looking for, and do so at a fraction of the cost that the mutual fund is doing it at that point, we'll likely pivot to an all ETF type platform. But for now, most of our portfolios consist of 50% ETFs, give or take, and 50% mutual funds. And that means, for an ETF, when we're looking at the total costs, an ETF comes in around 0.17 to 0.2 in total MER, so 0.2%. A mutual fund, or the mutual funds that we use, come in around 0.8, 0.9, 1% in total. So when we built
Greg, Greg, what's an MER?
So it's a management expense ratio. Every year when you are seeing performance in your accounts based off of your investments, you're seeing a performance that is net of fees. So there's a fee that's deducted. If your portfolio made 10% and the MER in your portfolio is 2, then the net performance, the total performance number that you'll see is actually 8%. So what we're doing is we're trying to shave off as much of that fee as possible for you. And by including these ETFs, we're able to reduce the average client's fee by roughly 0.5%. So before, if we didn't include ETFs, the very conservative version of Mark's portfolio was around a 1% total fee. Well, the new version of that portfolio comes in around 0.47%. The conservative one comes in around 0.51 and so forth. So you look at half a percentage on 100 grand, it's $500. So in the first year, we're able to save everyone around $500. Now, going forward, the savings starts to ramp up, and that is because of the factor of compounding and the effect of compounding over time. So in the beginning, it doesn't really look like much, and you probably won't see that effect. But over time, over the next 10, 15, 20, 30 years, that's going to equate to tens of thousands of dollars of savings in your portfolio. Now, this is an example showing 100,000. Let's just say you had $500,000 and you were starting, multiply that 76,000 by 5, that's, $200,000 to $300,000 of fee savings that we've been able to pass on to you. And that's going to be in the bottom line of your account that you're going to be able to use for your retirement. Anything you want to add here, Mark?
No, I think you covered it off pretty good. It's significant over time, Greg. And we all look at what's happening today. We can't help it with the media and the internet. And we look at what's happening over 1 week, but really we're all here trying to set up long-term investment portfolios. And some of you are 50, 60, 70 years old, and hopefully we're still looking at a 10, 15, 20, 30-year time horizon. Certainly for younger clients that are 35 years old and are looking at a 25 to 30-year time horizon to save for retirement, and then a 20 to 35-year payout time horizon, that 0.5% savings, which we may be able to, and we may be able to increase that when we move to an all ETF portfolio to a 0.75 point savings per year. It's certainly, this graph illustrates that's going to that amounts to just a whole bunch of additional value in the portfolio. Yeah,
I agree, and that's hopefully the move that we can make at some point in the next couple of years as the ETF landscape evolves and changes and gets better for advisors like us and for you. So let's pivot. Let's talk about market performance. So on this slide, here's what the performance of the major North American stock market indexes looks like year to date. The Canadian stock market index is in dark blue. It's known as the TSX Composite Index. The TSX Composite Index, it's basically an index of the 250 biggest companies in Canada. It's down around 12% year to date. The S&P 500, which is in light blue, and is the U.S. largest companies in the United States. It's the 500 biggest companies basically that are on the different exchanges in the U.S. It's down around 20%. That 20% number, it's significant. It's significant because when you're down 20%, it means that we're in what's known as a bear market, or that we've entered a bear market. The bear market that we're in today, specifically for US stocks right now, well, US stocks, regardless of which model I just showed you that we've rebalanced you into, it typically represents around 50% of the stock portion of your portfolio. And this bear market that we've experienced over the first 6-ish months of the year, it's the worst bear market we've ever seen in the first 6 months of the year since 1970. So, if you look at where we are today and where we're likely going to be in the future, I would say that from an entry standpoint, and I'll allude to this in a couple of slides, we all talk about wanting to buy low and sell high. Well, this is what I consider to be a great opportunity. But it's not just a bear market in stocks and equities, it's also been a bear market in bonds. And this slide here shows it's a position in an ETF, but it's an ETF that captures the entire bond market in the world. It includes bonds that are in Canada. 75 to 80% of the fixed income market in the world is actually in the United States. So if you were to look under the hood of this holding, it would show mostly US holdings. But then there's the European bond markets, there's the Bund market, the Japanese bond market, et cetera. The overall bond market, if you include every single bond in the world, it's basically down 10.46% year to date. So stocks are down, bonds are down, and this is a unique phenomenon. Mark, you're good at explaining this one. What's been going on in the bond market?
Yeah, Greg, it's been a challenging 6 months. First 6 months of 2022. This is the first time to this extent since the 1970s. This is the first, correction in financial assets where we've had everything going down together, almost all the stocks and all the bonds at the same time. If I started in the business in 1984 and have been through, many corrections and several bear markets, and all of them, virtually all of them, you had it when equities or stocks struggled, the bonds often did quite well. Bonds are considered a safe asset class. Stocks are considered a risk asset class, an equity. That's where the opportunity is in the long term. And so when we go through what we, go through a cycle, and every cycles last between 5 and this last one was about 13 years long, but normally, somewhere between 5 and 10 years, stocks are going to, there's going to be a couple periods of time where stocks get revalued and come down, and there's very often a rotation into bonds, which is a safe asset class, and that rotation into bonds drives interest rates down and provides capital gains, and the bonds do very well, and the conservative portfolios are quite stable. So that's what we have had in the last 8 or 10 corrections. The challenge with 2022 is it's the first time really since the 1970s where we've got significant inflation. And so what's happened in the first 6 months this year with all the inflation, interest rates are backing up quite quickly. And we're also having, a bit of, well, not a bit, we're having a correction in the equity markets, and individual clients, when they adjust their portfolios, if they adjust their portfolios, are not rotating from equities to bonds, because both the bonds are going down and the equities are going down. And so it's been a tough 6 months. So we have conservative portfolios that are down 10%, and we have growth portfolios that are down 20%. And so for all of our investors, it's been difficult. The good news is, when asset classes reprice and go down, including the bonds, there's more opportunity going forward.
Yeah. And that's a great point. And in 2 or 3 slides, we'll talk about expected returns. But real quickly, many of you have been rebalanced already to one of these conservative or very conservative or moderate or even growth models. To Mark's point, the conservative and very conservative models, which are around 40 to 50% stocks, in a normal correction, they would have been down maybe 3-4%, where equities, stocks are down 20%, but bonds, maybe they only go down 1 or 2 or 3%. Well, because bonds are down 10 and stocks are down between 10 and 25, there's really no escaping it. And we've used some strategies inside of your portfolios, such as we've added a little bit of gold, which is a non-traditional asset class. Depending on the model, you might have 10% or 15% gold, all the way to 5% gold. That's done relatively well, and that's the reason why we hold gold. But also, not included in this performance is if you've got an alternative asset class like the commercial real estate pool through Great-West Life, that's actually been positive 5 or 6%. It's not a traditional type investment, which is why we don't include it in the performance of this model. However, many of you own this. So if you take the weighted average performance and you've got, say, a 10 to 20% allocation to the real estate holding and 80% in, say, one of these models, you might not actually be down 10%. You might only be down 5 or 6% because of the real estate allocation. But in essence, where I'm going with this by showing you this slide is we're doing really well, like relatively well. We're not worse than the market. We're actually on par, if not slightly better than the market. And that's because the investments that we do focus on, sure, we're using ETFs, but some of the funds that we're using in the gold position, they're doing better than stocks and bonds. And having those inside of your portfolio has added 1, 2, 3, 4% of performance and has allowed us to actually outperform. So I know it's been challenging for everyone to see their accounts go down. It could be significantly worse. And all things considering, I've been very happy so far with the way all of our models have performed, relatively speaking. Nobody wants to see their portfolio down 20%, but it's better than being down what the index is down, potentially 25, 30% in some cases if you had even more risk. So, Mark, one of the things that's been coming up as we get to the end of this presentation has been, we're about to enter a recession, or are we in a recession right now? And I found a piece that just speaks to the US Treasury market and yield curves. And if we talk about yield curves, specifically the US yield curve, which is the one that everyone talks about when they're referring to a yield curve, what's happened in the past 6 months is that the yield curve has inverted. So when you hear that the yield curve has inverted, what exactly does that mean? Well, it means that what you say it, Mark. What does it mean?
No, sorry for cutting in. It just means that short-term yields or short-term interest rates are higher than long-term interest rates or long-term yields. And over the last 10 bear markets, probably about 80% of them have been predicted by inverted yield curves. So when the yield curve inverts, it means that that the central banks are raising interest rates to try to slow things down, and they push up short-term rates to try and slow down consumer spending, to try and just slow down the economy. And in our case right now, they don't really want to slow the economy down, but they want to slow down inflation, right? Yeah. Inflation is running at 7 to 10% everywhere in the world. And really the only tool they have right now is to push up short-term interest rates hopefully just for a short period of time. But as they do that, then you start to see that, in this graph, the 2-year yield is 2.914% and the 10-year yield is 2.89. So that is just slightly inverted, meaning the longer end of the yield curve is a little bit lower than the short.
Yeah.
And over time, over history, that's been a pretty good indicator for a slowdown and quite often for a mild recession.
Yeah. Well, taking a look at the next, I found this chart interesting, the next, year, year and a half, 2 years ahead, which speaks to, the implied yield curve. So it looks like, we're going to be raising rates in North America, and the world's going to be raising rates quite substantially for the remainder of the year. We're in the United States coming around to 1.5%, 1.75% overnight rate. And eventually we're going to get to, double that by early 2023. However, what I'm seeing here and what the market's actually predicting, especially as we looked at that yield curve inverting and the 5 and the 10-year being lower than the 2-year, is that we're actually expecting starting in 2023 for yields to start going down. And yields typically only start going down when there's something going wrong with the economy. Either we're entering a recession or we're in a recession. And that's because central banks are trying to stimulate the economy. So at some point, end of this year, beginning of next year, the switch is going to flip. And it looks like, we're going to shift from being in a rising rate environment to a decreasing rate environment. And it's interesting because when that happens, when rates actually start to go down, the stock market reacts very positively, very favorably, or at least it has over the past 2 or 3 cycles. And when I look at the S&P 500, I look at the level it's at today, it's around 3,800. That's the index of the 500 largest companies in the United States. It's trading 20% down. Well, we're expecting the yield curve to remain inverted and eventually in 2023 for rates to start to come down for us to enter a recession. But all of the biggest banks in North America and the world, they're all predicting that by the end of this year, beginning of next year, that the S&P 500 is going to recover around 15% of what it's already lost. In some cases, barely be down, maybe down 3, 4, 5%. And be almost back to where we were in January, or around where we were in January of this year. And that's because equity markets, stock markets are always looking ahead 6 months, a year, 2 years. And it's forecasting that it's going to be really accommodative for stocks when those rates start to go down. So you can see if you wanted to react, it's really tough to react and call these things, but making a change in your portfolio during a recession, well, you've already kind of missed the boat. When you want to make a change or when you want to get invested, it's at a time like now where markets are down 10, 15, 20%. If I go to the next slide, and as we come to the second last slide here, this is a slide that's speaking to the expected return of all the different types of stocks you can have, different asset classes, as well as different types of bonds. And Mark and I review this slide, and we don't typically share it with clients very often, but we look at this slide often. It's put together by BlackRock. BlackRock is the biggest financial institution in the world. And if I looked at this, or if I look at it today, it's basically saying that they expect stocks to have somewhere of an expected return of between 5, 6, and 10%. So on average, stocks are going to get us around 7, 8%. When I looked at this exact same piece 9, 10 months ago, end of last year, stocks were only expected to return somewhere between 5 and 6 or 7%. So the expected return of stocks goes up when stock markets go down. Also, bonds, which are the yellow lines that you see there, you have the different bond markets. Bonds were expected 7, 8, 9, 10 months ago to have a 0% return. But now that the bond market's down in aggregate around 10%, well, the total expected return for bonds has gone up. And the bonds that you have in your portfolio, well, instead of getting a 0, are now likely going to return somewhere in the ballpark of between 2 to 5%, which is great, which means that our bonds are going to get us, 2, 3, 4, 5%. Our stocks are going to get us 7%. If you're in a balanced portfolio, we're probably going to experience over the long term, starting now, you know, a 5, 6, 7% return all in, which is quite attractive. Anything you want to add, Mark, before we end things up on the next slide?
Well, yeah, just that those returns Greg is talking about, those are, when we talk returns, we talk over a 10-year period or longer.
Yes.
I mean, not everyone has to have their money invested for that length of time, but yeah, but this chart that BlackRock does and puts out, they probably put it out every week, but we look at it every month. It's anticipated returns for the various asset classes over a 10-year period. So it was fairly depressing, as Greg said, about 10 months ago, because interest rates were zero, or a year ago, and because stocks were quite fully valued, perhaps overvalued, and residential real estate was perhaps overvalued. When BlackRock studies these asset classes and says, well, if we put the pieces together, what are people going to make in their portfolios over the next 10 years? The returns didn't look very good. And the point is, Greg, is, because of the correction, yes, you look at it and you get a little nervous because your portfolio is down 10 or 12% or 8%. But the good news is, going forward, we now have a chance to make 5 or 6% compounded annually over the next 10 years.
Yeah, which is a great way to end things. Thank you. If you've tuned in this long to hear us, Mark's introduction of me, the understanding of what I hope to accomplish and achieve for you within your respective portfolios and the financial planning that we'll do together. If you tuned in this long, I really appreciate that, or we really appreciate it. Call to action. If there's anything that, we can say is, from a market timing standpoint, we don't know what's going to happen for the next 6 months. We do know that markets are attractive today. And if you've been hesitant to want to put some money to work, if you've got cash on the sidelines, you've got stuff sitting in your bank account, maybe you're planning on taking a trip, your flight got canceled, something along those lines, and you'd like to put that money in your accounts with us to be invested, I think, and Mark and I both think, now is probably a really good time to do so. Because even though we might be entering an economic recession, the stock market at some point, likely in the next 6 months to year, is going to have already fully recovered to where it was at the beginning of this year and likely be making new highs. Anything you want to add before we sign off?
Just for anyone that's hung in there for the last 20 minutes, half an hour, thank you very much for listening. Greg and I are going to do our very best going forward we always do our very best, but we're going to do our very best to get to all of you, talk to you about some of these new products, try and bring your costs down. And certainly, if any of you have any concerns, give us a call. Any concerns or any anxieties, give us a call, and we'll address them as soon as we can.
Thank you. Thanks, Mark. Well said. Thanks, everyone. Cheers.
Thank you.